You know what's wild? Every single day, you participate in the most complex machine ever built by humanity. No, I'm not talking about your iPhone or the International Space Station. I'm talking about the American economy. Right now, as you're watching this video, somewhere in Iowa, a farmer is deciding how much corn to plant. In New York, a trader is buying stocks they don't understand. In California, someone just invented an app that lets you rate your neighbor's lawn. And somehow, all of this chaos works together to create the largest economy in human history. The American economy is worth about $28 trillion. That's 28 with 12 zeros behind it. That's more than the entire economies of China, Japan, Germany, and the UK combined. It's so big that if it were a person, it would be too big to fail, too big to jail, and definitely too big to fit through your front door. But here's the thing nobody tells you. The economy isn't some distant, boring thing that only matters to people who wear suits and say words like fiscal and macroeconomic indicators. The economy is literally everything. It's why your coffee costs $5. It's why your rent is insane. It's why your cousin Brad thinks he's going to get rich trading cryptocurrency, and it's why he's probably wrong. In this video, we're going to break down exactly how this massive, beautiful, occasionally terrifying machine actually works. We're going to talk about money, jobs, banks, the stock market, trade, and why economists are basically just fortune tellers with better math skills. By the end of this, you'll understand more about the economy than 90% of people who confidently post about it on Twitter. And unlike those people, you'll actually know what you're talking about. Let's dive in. Section 1. The Foundation. What even is an economy? Chapter 1. Economics is just fancy trading. Let's start at the absolute beginning, because if we don't, none of the rest of this will make sense. An economy is just a system where people trade stuff. That's it. That's the whole thing. Everything else is just details. Think about it like this. You're good at making pottery. Your neighbor Steve is good at catching fish. You need fish, Steve needs pots. You trade. Boom. Economy. Congratulations, you just did economics. Now that's a tiny economy involving two people and two products. The American economy is the same concept, except instead of two people, it's 335 million people, and instead of pots and fish, it's everything from smartphones to financial derivatives that nobody understands, including the people who created them. The reason economies exist is actually pretty simple: specialization. You could theoretically grow your own food, build your own house, make your own clothes, and perform your own dental surgery. But you'd be terrible at most of those things, and you definitely regret the dental surgery. Instead, you specialize in one thing, get paid for it, and use that money to buy everything else from people who specialize in those things. The dentist who fixes your teeth can't grow wheat, but they don't have to because the farmer does that. The farmer can't fix teeth, but they don't have to because the dentist does that. Everyone does what they're best at, trades with everyone else, and we all end up with better teeth and better sandwiches. This is called division of labor, and it's basically the cheat code that let humanity go from living in caves to building Tesla factories, which, depending on your perspective on Elon Musk, may or may not have been a good idea. Chapter 2. Money is a collective hallucination, and that's fine. Now, here's where it gets interesting. In our pottery and fish economy, trading is pretty straightforward. But what happens when you want to buy something from someone who doesn't want your pottery? Let's say you want a haircut, but the barber already has 17 pots and is frankly sick of pottery. In the old days, you'd have to find someone who wants pottery and has something the barber wants, then do this complicated three-way trade. This is called barter, and it's incredibly annoying. So humanity invented money. Money is basically just a universally agreed upon stand-in for value. Instead of carrying around pots to trade, you sell your pots for money, then use that money to buy a haircut. The barber doesn't have to want pots. They just have to want money, which they can then use to buy whatever they actually want. Here's the mind-blowing part. Money only works because we all believe it works. That dollar in your pocket? It's a piece of paper. It has no inherent value. You can't eat it, you can't build a house with it, and if you try to use it as clothing, you'll get arrested. The only reason that dollar is worth anything is because everyone agrees it's worth something. It's a collective hallucination, except instead of seeing dragons, we all see value in small green rectangles. The technical term for this is fiat money. Fiat means by decree. Basically, the government says this is money, and we all go along with it because the alternative is going back to carrying around pots. This seems insane until you realize that literally all money throughout history has been some version of a collective hallucination. Gold? It's just a shiny rock. We decided it was valuable. Seashells? Same thing. Bitcoin? Don't even get me started. The American dollar is particularly special because it's not just America's collective hallucination, it's the world's collective hallucination. More on that later. Chapter 3. The three players in every economy. Every economy has three main groups of players, and they're all trying to do different things. First, you've got households. That's you, me, your parents, that guy who's definitely living in a van down by the river but insists he's self-actualizing. Households consume stuff. We buy groceries, pay rent, subscribe to 17 streaming services we barely use, and occasionally buy things at 2 a.m. that seem like great ideas but definitely aren't. Households also provide labor. We work jobs, earn money, and then spend that money on stuff, which keeps the whole machine running. We're basically the fuel and the engine and the passenger all at once, which seems inefficient but somehow works. Second, you've got businesses. These are the entities that produce goods and services. Everything from the mega corporation that made your phone to the small coffee shop where the barista judges your order. Businesses hire workers from households, pay them money, then sell products back to households for more money than it costs to make them. The difference is called profit, and it's basically the whole point. Businesses are theoretically supposed to compete with each other, which keeps prices low and quality high. In practice, many of them would much rather just buy all their competitors and form monopolies, but we have laws against that now. Mostly. Sometimes. When we feel like enforcing them. Third, you've got the government. The government is like the referee in a sports game, except this referee can also tax you, print money, build roads, start wars, and declare that yes, pizza is a vegetable for school lunch purposes. The government does a bunch of things in the economy. It builds infrastructure, enforces laws, regulates businesses, provides services like education and national defense, and occasionally gives everyone money when things get really bad, like during a pandemic. Remember that? The government gets its money primarily through taxes, which is when they take some of your money whether you like it or not. Most people don't like it, but most people also like roads and not being invaded by Canada, so it evens out. These three groups, households, businesses, and government, are constantly interacting. Households work for businesses and buy from businesses. Businesses pay households and pay taxes to the government. The government taxes households and businesses and spends that money on stuff that theoretically benefits everyone. When this interaction flows smoothly, the economy grows. When it doesn't, you get recessions, depressions, and people on the news using the phrase economic uncertainty, which is fancy talk for nobody knows what's happening. Section 2, How Money Actually Works. Chapter 4, The Federal Reserve, the wizard behind the curtain. Let's talk about the most powerful institution you've never thought about, the Federal Reserve. The Federal Reserve, or the Fed if you want to sound like you know what you're talking about at dinner parties, is America's central bank. It's not actually part of the government, but it's also not really a private bank. It's this weird hybrid that exists to manage America's money supply and keep the economy from completely losing its mind. The Fed was created in 1913 after a series of financial panics convinced everyone that maybe, just maybe, we needed someone to be in charge of the money situation. Before the Fed, American banking was like the Wild West, except instead of gunfights, there were bank runs, and instead of outlaws, there were just regular banks doing crimes. So what does the Fed actually do? First, they control how much money exists. Remember how we said money is a collective hallucination? Well, the Fed is in charge of that hallucination. They can literally create money out of thin air, which sounds like it should be illegal, but is actually their whole job. When the economy needs more money flowing around, the Fed creates it. When there's too much money flowing around, they destroy it. Not physically. They're not in some basement with a paper shredder. It's all digital. They basically just change numbers in computers, and boom, there's more or less money in existence. Second, they set interest rates. Interest rates are basically the price of borrowing money. When you take out a loan, the interest rate is what you pay for the privilege of using someone else's money before you actually have it. The Fed doesn't directly set the interest rate you pay on your car loan or mortgage, but they set the federal funds rate, which is the rate that banks charge each other for overnight loans. This rate influences all other interest rates in the economy through a complex chain of events that economists love explaining and normal people love ignoring. When the Fed wants to stimulate the economy, get people spending and businesses investing, they lower interest rates. Borrowing becomes cheaper, so people borrow more, spend more, and the economy grows. When the economy is growing too fast and inflation is getting out of control, the Fed raises interest rates. Borrowing becomes more expensive, people borrow less, spend less, and the economy cools down. It's like a thermostat for the economy, except instead of controlling temperature, they're controlling how enthusiastically people buy houses and start businesses. Third, the Fed regulates banks. They make sure banks aren't doing incredibly stupid things with your money, like investing it all in lottery tickets or using it to fund their CEO's yacht collection. Banks are required to keep a certain amount of reserves, actual money they can't lend out, just in case everyone shows up at once asking for their deposits back. This hasn't always worked perfectly. In 2008, it turned out a lot of banks were doing incredibly stupid things with people's money, and the Fed's regulation wasn't quite enough to prevent the entire financial system from nearly collapsing. But hey, we learned from that, right? Right? Chapter 5. Banking, where money goes to multiply. Let's talk about banks, because banks are weird. You deposit $100 in your bank account. You think that $100 is sitting in a vault somewhere with your name on it, waiting patiently for you to withdraw it. That is absolutely not what's happening. Here's what's actually happening. The bank takes your $100, keeps about $10 of it in reserve, the exact amount varies based on regulations, and then lends out the other $90 to someone else. That person who borrowed $90 uses it to buy something, let's say a bike. The bike seller deposits that $90 in their bank account. Now their bank keeps $9 in reserve and lends out $81. That money gets spent, deposited, lent out again, and so on. This is called fractional reserve banking, and it's basically financial sorcery. Your original $100 deposit has now created $100 plus $90 plus $81 plus in total money in the economy. That one deposit has multiplied into several $100s worth of economic activity. This is wild. The bank doesn't have your actual money. They have a fraction of your money and a promise that they can get the rest if you ever want it back. And this works fine as long as everyone doesn't want their money back at the same time. When everyone does want their money back at the same time, it's called a bank run, and it's very bad. This is why we have the FDIC, the Federal Deposit Insurance Corporation, which insures your deposits up to $250,000. If your bank fails, the government makes sure you get your money back. This stops bank runs because people know their money is safe even if the bank isn't. Banks make money in a pretty straightforward way. They pay you a tiny amount of interest on your deposits, then lend that money out at a much higher interest rate. The difference is their profit. Right now, your savings account probably pays you something like 0.5% interest annually, which is basically nothing. Meanwhile, the bank is lending that money out as mortgages at 7%, car loans at 6%, and credit cards at an absolutely criminal 20 to 30%. The bank is making a killing on the difference, which is why bank CEOs have nice houses and you don't. Chapter 6. Inflation. Why everything costs more than it used to. Remember when candy bars cost a nickel? No, you don't, because you're not 90 years old, but your grandparents do, and they won't stop talking about it. This is inflation. Inflation is when the general level of prices goes up over time. It means your dollar buys less than it used to. It's why everything seems more expensive than it was when you were a kid, and it's not just because you're older and more bitter. Inflation happens for a few reasons. Reason 1, more money, same amount of stuff. Remember how the Fed can create money? Well, if they create a lot more money but the economy doesn't produce a lot more stuff, you end up with more dollars chasing the same amount of goods. Prices go up. Imagine there are 100 apples and $100 in the economy. Each apple costs $1. Now imagine the Fed creates 100 more dollars, but there are still only 100 apples. Now there are $200 competing for 100 apples, so the price goes up to $2 per apple. Same apples, but they cost more because there's more money around. Reason 2, Supply shocks. Sometimes stuff just becomes harder to produce. A pandemic shuts down factories. A war disrupts oil supplies. A ship gets stuck in the Suez Canal and suddenly the global supply chain is backed up like a clogged toilet. When it's harder to get stuff becomes more expensive. This is called supply-side inflation, and it's usually temporary unless the underlying problem isn't fixed. Reason 3. Demand shocks. Sometimes everyone suddenly wants the same thing. During the pandemic, everyone decided they needed home gym equipment simultaneously. Prices skyrocketed. When the government sends everyone stimulus checks and people have more money to spend, demand for goods goes up and prices follow. Reason 4. Wage price spirals. Workers demand higher wages to keep up with rising prices. Businesses raise prices to cover higher wages. Workers demand even higher wages to keep up with even higher prices. Round and round we go until someone, usually the Fed, steps in and raises interest rates to cool everything down. A little bit of inflation is actually good. The Fed targets about 2% inflation per year. This encourages people to spend and invest money rather than hoarding it, because money sitting under your mattress is slowly losing value. But too much inflation is bad. Really bad. When inflation gets out of control, you get hyperinflation, which is when prices rise so fast that money becomes basically worthless. Zimbabwe once had inflation so bad, they printed a $100 trillion bill that couldn't even buy a loaf of bread. That's not a fun time for anyone except collectors of weird currency. The opposite of inflation is deflation, when prices go down over time. This sounds good until you realize it means your money is worth more if you just hold on to it, so everyone stops spending, businesses fail, unemployment rises, and the economy spirals into depression. Deflation is actually scarier than inflation, which is why central banks fight it aggressively. The Fed's job is to keep inflation in that sweet spot, high enough that people keep spending, low enough that your salary doesn't become worthless before you can spend it. 8:44 p.m. Section 3. The Job Market, where your time becomes money. Chapter 7. Employment, trading your life, hours for currency. Let's talk about jobs, because unless you're independently wealthy or have a very successful OnlyFans, you probably need one. The job market is where labor gets bought and sold. You have time, skills, and energy. Employers have money and need things done. You trade your time and skills for their money. It's like any other market, except instead of selling pottery, you're selling chunks of your finite existence on Earth. Fun. The American job market employs about 160 million people. That's roughly half the population, which makes sense. Because the other half is either too young, too old, too rich, or has decided that traditional employment is for suckers and they're going to become a crypto influencer instead. Jobs exist because of specialization. Remember? Businesses need people who are good at specific things. Maybe they need someone who understands tax law. Maybe they need someone who can code. Maybe they need someone who's willing to dress up as a hot dog and stand on a street corner. The economy needs all of these people, even the hot dog person. Here's how it works. Businesses post jobs. You apply. They interview you and try to figure out if you're competent and also whether they can stand being around you for 40 hours a week. You try to convince them you're worth hiring while also trying to figure out if this job will make you want to drive your car into a lake. If both parties decide they can tolerate each other, you get hired. You show up, do work, and receive money in exchange. This money is called your wage or salary, and it's supposed to be enough to live on. Though whether it actually is depends heavily on where you live and what the business feels like paying you. Chapter 8. Wages. Why some people make more than others. Here's a question that makes people uncomfortable. Why does a doctor make more than a teacher? Why does a software engineer make more than a social worker? Why does a CEO make 300 times more than the average worker when they're arguably 300 times worse at their job? Welcome to Wage Determination, where the answers are complicated and nobody's happy. In theory, wages are determined by supply and demand, just like everything else in economics. If a skill is rare and valuable, it commands a high wage. If a skill is common or easily replaced, it commands a low wage. Doctors make a lot of money because becoming a doctor requires over a decade of education. The work is highly skilled, and there's a limited supply of people willing to memorize every bone in the human body and then spend their career dealing with people's medical problems. High demand, limited supply, high wages. Fast food workers make less money because the skills required are more common and the training period is much shorter. Lots of people can do the job, so the supply of workers is high, which pushes wages down. This doesn't mean the work isn't hard or important. It absolutely is. But from an economic standpoint, there are more people who can do it. That's the theory. The reality is messier. Wages are also determined by negotiating power. If you're the only person who can do a specific thing, you have leverage. If there are 10,000 people who can do what you do, you don't. This is why specialized skills pay more and why unions exist. Collective bargaining gives workers more negotiating power. Education and credentials. A college degree signals to employers that you can stick with something for 4 years and absorb information, even if most of what you learned isn't directly relevant to the job. The degree itself is valuable regardless of the specific knowledge, which is why English majors end up working in marketing, industry, and company. Tech companies pay more than nonprofits. Finance pays more than education. Some of this reflects profitability. Tech companies make a lot of money and can afford to pay more. Some of it reflects what industry society values, which is often not the industries that contribute the most to human well-being, but that's a different discussion. Location. A software engineer in San Francisco makes way more than a software engineer in rural Kansas, partly because San Francisco has more tech companies competing for talent, and partly because San Francisco is so expensive that you need a huge salary just to afford a closet-sized apartment. Discrimination. Yeah, we need to talk about this. Women make about 82 cents for every dollar men make. Black workers make less than white workers for the same jobs. This isn't because of skill differences. Study after study shows this is actual discrimination, both conscious and unconscious. It's illegal, but it still happens, and it's a major factor in wage inequality. Pure luck and timing. Sometimes you graduate during a boom and walk into a great job. Sometimes you graduate during a recession and spend 2 years working at Starbucks. Through no fault of your own, your lifetime earnings can vary by hundreds of thousands of dollars based on the year you happen to be born. Oh, and then there's CEO pay, which is its own special kind of insane. The average CEO of a major corporation makes about $15 million per year. The average worker makes about $60,000. That's a 250 to 1 ratio. Is the CEO doing 250 times more work? No. Are they 250 times smarter? Definitely not. Are they 250 times more valuable? Here's where it gets complicated. CEOs get paid huge amounts because they're making decisions that affect billions of dollars, so even a small improvement in decisions is worth a lot. There's a limited pool of people with the experience to run huge companies. CEO pay is often set by other CEOs on the board, and shockingly, CEOs think CEOs should make a lot of money. Much of CEO pay is in stock options, which aligns their incentives with shareholders and also sometimes encourages short-term thinking that boosts stock prices while harming long-term company health. Is this fair? That's a political question disguised as an economics question, and people have very strong feelings about it. Chapter 9. Unemployment. When the economy doesn't need you. Not everyone who wants a job has one, and that's a problem. The unemployment rate measures the percentage of people who want to work but can't find jobs. Right now it's around 4%, which sounds pretty good until you remember that's still millions of people. But here's the weird part. 0% unemployment is actually bad. Wait, what? Economists believe there's a natural rate of unemployment somewhere between 3 to 5%. This is because some unemployment is actually healthy and normal. Frictional unemployment is when people are between jobs. They quit one job and are looking for another, or they just graduated and are searching for their first job. This is temporary and not really a problem. In fact, it's good. It means people have the freedom to find better matches instead of being stuck in jobs they hate. Structural unemployment is when people's skills don't match available jobs. Maybe you're a coal miner, but all the coal mines closed. Maybe you're a travel agent, but everyone books trips online now. Your skills became obsolete and you need retraining. This is harder to fix, but still a normal part of economic change. Cyclical unemployment is the bad kind. This is when the overall economy is in recession and businesses aren't hiring because demand is down. There aren't enough jobs, period. People want to work, businesses need workers, but the economic conditions aren't right for matching them up. This is what the government and the Fed try to fix with stimulus and monetary policy. When unemployment is too low, wages rise rapidly because businesses have to compete for scarce workers. This sounds great until you realize it can trigger inflation, as businesses raise prices to cover higher wages, which makes everything more expensive, which causes workers to demand even higher wages, and we're back in that wage price spiral we talked about earlier. When unemployment is too high, you get wasted human potential, poverty, social problems, and a general sense that maybe this whole capitalism thing isn't working out so great. The government tracks unemployment through surveys, though the official number can be misleading. It doesn't count people who've given up looking for work entirely, or people who are working part-time but want full-time jobs. When you include those people, the real unemployment rate is usually higher than the headline number. Chapter 10. The Gig Economy. When everyone's a freelancer and no one has benefits. Let's talk about the newest development in the job market, the gig economy, where traditional employment goes to die and is replaced by a bunch of independent contractors delivering food and driving strangers around. The gig economy refers to short-term, flexible work arrangements instead of traditional full-time employment. Uber drivers, DoorDash delivery people, freelance writers, Airbnb hosts, TaskRabbit handy people, these are all gig workers. About 36% of American workers now do some kind of gig work, either as their primary income or as a side hustle. That's a huge chunk of the workforce that's operating outside the traditional employment model. For workers, the gig economy has upsides, flexibility. You work when you want, where you want, low barriers to entry. You can start driving for Uber tomorrow. Autonomy. You're your own boss, kind of multiple income streams. You can do several different gigs. And downsides. No benefits, no health insurance, no retirement plan, no paid vacation, income instability. Your earnings vary wildly week to week. No job security. You can be deactivated from a platform at any time. You bear all the costs. Your car, your gas, your equipment, no labor protections, minimum wage laws, and overtime don't apply to contractors. For businesses, the gig economy is fantastic. They get flexible labor without the cost of benefits, payroll taxes, or long-term commitments. They've essentially outsourced all the risk to workers while keeping all the control. This has led to huge legal battles over whether gig workers should be classified as employees with protections and benefits, or independent contractors with none of those things. Companies like Uber and Lyft have spent hundreds of millions of dollars lobbying to keep their workers classified as contractors, which should tell you something about which classification is more profitable for them. The gig economy represents a fundamental shift in how work is organized. We're moving from stable, long-term employment with a social safety net to unstable, short-term arrangements where everyone's on their own. Whether this is disruption and innovation, or making everything worse while calling it progress, depends largely on whether you're a gig worker or a gig company investor. Section 4, Business and Production, How Stuff Gets Made. Chapter 11, How Businesses Actually Work Time to talk about businesses, because they're the entities that produce pretty much everything you use, consume, or accidentally break. A business is an organization that produces goods or services to make a profit. That's it. That's the entire purpose. Everything else, the mission statements, the corporate values, the ping-pong tables in the break room, is secondary to making money. Businesses come in different sizes. You've got sole proprietorships, one person doing everything. Think freelancers, independent contractors, that person who started a dog walking business. You are the business. If the business gets sued, you get sued. If the business fails, your personal assets are at risk. It's simple but risky. Partnerships. Two or more people sharing ownership, profits, and liability, like a sole proprietorship, but with more people to argue with. Law firms and medical practices often use this structure. Corporations, separate legal entities from their owners. This is the big one. Corporations can own property, sign contracts, sue, and be sued, all independent of the people who own them. If a corporation fails, the owner's personal assets are protected. This is called limited liability, and it's one of the most important innovations in economic history. Corporations issue stock, little pieces of ownership. If you own stock, you own part of the company. If the company does well, your stock becomes more valuable. If the company fails, your stock becomes worthless, but at least they can't come after your house. There are private corporations, owned by a small group of people, and public corporations. Anyone can buy stock on the stock market. Going public, doing an IPO, initial public offering, is how companies raise massive amounts of money from investors. LLCs, limited liability companies. A hybrid structure that gives you the liability protection of a corporation with the tax benefits of a partnership. Small and medium businesses love these. Now, how do businesses make money? Revenue is all the money that comes in from selling stuff. If you sell 100 widgets for $10 each, your revenue is $1,000. Costs are all the money you spend to run the business. Materials, wages, rent, that espresso machine for the break room that was supposed to improve morale but mostly just created coffee snobs. Profit is revenue minus costs. If your revenue is $1,000 and your costs are $700, your profit is $300. This is what the business gets to keep, and it's the whole reason businesses exist. Businesses fail when costs exceed revenue for too long. They run out of money, can't pay their bills, and shut down. About 20% of new businesses fail within the first year. About 50% fail within 5 years. Starting a business is risky, which is why successful entrepreneurs get rewarded with profits. Chapter 12. Supply and Demand, the only economics concept you actually need. Here's the secret. Pretty much everything in economics comes down to supply and demand. If you understand this, you understand 80% of how the economy works. Demand is how much of something people want to buy at different prices. Generally, when prices are low, people want to buy more. When prices are high, people want to buy less. This is called the law of demand, and it makes intuitive sense. If pizza is $5, you might buy 3 slices. If pizza is $50 a slice, you might decide you're not that hungry. Supply is how much of something producers are willing to sell at different prices. Generally, when prices are high, producers want to sell more because they make more profit. When prices are low, producers want to sell less because it's barely worth their time. This is the law of supply. The magic happens where supply and demand meet. This is called the equilibrium price, the price where the amount people want to buy exactly equals the amount producers want to sell. Let's say at $10 per widget, people want to buy 1,000 widgets and producers want to sell 1,000 widgets. Perfect. The market is in equilibrium, everyone's happy, but what if producers try to charge $20 per widget? Now people only want to buy 500 widgets, but producers want to sell 1,500 widgets. There's a surplus. Producers are stuck with 1,000 widgets nobody wants. They'll have to lower the price to sell them. What if producers only charge $5 per widget? Now people want to buy 2,000 widgets, but producers only want to sell 500. There's a shortage. People are competing for limited widgets, which allows producers to raise prices. Through this process, prices naturally move toward equilibrium. It's like an invisible hand guiding the market, which is literally what Adam Smith called it back in 1776. And we've been using that metaphor ever since because it sounds cooler than mathematical optimization process. This is why price controls often backfire. If the government sets a maximum price below equilibrium, like rent control, you get shortages. Everyone wants to rent apartments, but landlords don't want to supply them at that price, so there aren't enough apartments. If the government sets a minimum price above equilibrium, like a minimum wage, you can get unemployment. More people want to work at that wage, but businesses want to hire fewer people, so not everyone who wants a job can get one. Note, this is the theoretical concern. In practice, minimum wage increases often don't cause unemployment because labor markets are more complicated than simple supply and demand models, but that's a whole other debate. Chapter 13. Competition versus Monopoly. Why your cable company sucks. In theory, capitalism works because of competition. Multiple businesses compete for customers by offering better products or lower prices. This benefits consumers and drives innovation. In practice, businesses hate competition and try to eliminate it whenever possible. Perfect competition is the economic ideal. Lots of small firms selling identical products, easy entry and exit from the market, perfect information for consumers. In this world, no single business can control prices. They have to accept whatever price the market sets. Farmers selling corn are pretty close to this model. Monopoly is when one company controls an entire market. They can set prices as high as they want because consumers have no alternatives. Monopolies are bad for consumers but great for the monopolist, which is why businesses love becoming monopolies and consumers hate when they succeed. Oligopoly is when a few large companies dominate a market. Think airlines, wireless carriers, or beer companies. They don't quite have monopoly power, but they also don't really compete that hard because there are so few of them. Sometimes they even coordinate to keep prices high, which is illegal but hard to prove. The US has antitrust laws designed to prevent monopolies and promote competition. The government can break up companies that get too powerful, block mergers that would reduce competition, and prosecute companies that collude to fix prices. Famously, the government broke up Standard Oil in 1911 because it controlled 90% of oil refining and was crushing all competition. More recently, there have been calls to break up tech companies like Google, Amazon, and Facebook because they've become so dominant in their markets. But antitrust enforcement has been weak for decades. Companies have gotten very good at convincing regulators that their size benefits consumers through efficiency and innovation, even as they crush competitors and raise prices. This is why you have limited choices for internet providers, and they all have terrible customer service. When you're one of the only options, you don't have to try very hard. Chapter 14: Innovation and Creative Destruction. Here's something weird about capitalism. It's constantly destroying itself and rebuilding. Joseph Schumpeter called this creative destruction. New technologies and business models emerge, make old ones obsolete, create new winners and losers, and the economy evolves. Think about how many businesses have been destroyed by the internet. Blockbuster, dead, killed by Netflix. Tower Records, dead, killed by iTunes and Spotify. Newspapers, mostly dead, killed by free online news. Travel agencies, mostly dead, killed by Expedia and Google Flights. This is painful for the businesses and workers in declining industries, but it's how the economy grows and improves. Resources get reallocated from less productive uses to more productive ones. The automobile destroyed the horse and buggy industry, but created millions of new jobs in manufacturing, sales, repair, road construction, gas stations, and eventually app-based ride-sharing that makes you question your career choices while stuck in traffic. Innovation comes from research and development. Companies invest in creating new products and technologies. Entrepreneurship. People start new businesses with new ideas. Competition. Businesses innovate to get an edge over competitors. Government funding. A lot of basic research happens at universities funded by government grants. The internet, GPS, touchscreens, and the algorithm behind Google were all developed with government research funding, then commercialized by private companies. The government does the risky, expensive basic research with no clear profit motive, then the private sector figures out how to make money from it. Silicon Valley's entire business model is basically take technologies developed with public funding, add some software, claim you invented it, and become a billionaire. Innovation drives productivity growth, which is the main way economies improve living standards over time. If workers can produce more output per hour, there's more stuff to go around, and everyone can potentially have a higher standard of living. But innovation also creates winners and losers. The programmer who learned to code makes 6 figures. The factory worker whose job got automated is unemployed. Managing this transition, helping displaced workers retrain and find new jobs, is one of the biggest challenges facing the economy. We're not always great at it. Section 5. The Financial System, where money makes money. Chapter 15. The stock market. Legalize gambling for rich people. The stock market is where pieces of companies get bought and sold, fortunes are made and lost, and millions of people check their retirement accounts and then immediately regret it. Here's how it works. Companies issue stock, ownership shares. You buy stock, you own part of the company. If the company does well, the stock price goes up, and you can sell it for more than you paid. If the company does poorly, the stock price goes down and you lose money. Simple, right? Except it's not simple at all because stock prices don't just reflect how well the company is currently doing. They reflect how well investors think the company will do in the future. And investors are often wrong, very wrong, hilariously wrong. This is why Tesla, a car company that sells fewer cars than Toyota, has been valued higher than Toyota. Investors are betting on the future. They think Tesla will dominate electric vehicles, autonomous driving, and possibly build a robot butler that does your taxes. Whether this actually happens is anyone's guess, but the stock price reflects the collective betting of millions of investors. The stock market serves several important functions. It lets companies raise money. When a company goes public and sells stock, it gets a huge influx of cash to invest in growth. Google raised $1.67 billion in its IPO and used it to build the infrastructure that now dominates internet search and collects your personal data. It lets investors own productive assets. Instead of keeping your money in a low-interest savings account, you can buy stocks and participate in the growth of the economy. Over the long term, the stock market returns about 10% annually, which is way better than the 0.5% your savings account pays. It provides liquidity. You can sell your stocks quickly if you need cash. Try selling your house quickly and you'll understand why liquidity matters. It signals information. Stock prices aggregate the opinions of millions of investors. When a stock crashes, it's a signal that something might be wrong with the company. There are different types of stocks. Common stock. You own part of the company and get to vote on company decisions, though unless you own a lot, your vote doesn't matter. Preferred stock. You don't get voting rights, but you get paid dividends before common stockholders. Growth stocks. Companies that reinvest profits to grow rather than paying dividends. Tech stocks are usually growth stocks. Value stocks. Established companies that pay regular dividends. Boring but steady. Then there are stock indexes, which track the performance of groups of stocks. The S&P 500, the 500 largest U.S. companies. When people say the market, they usually mean this: the Dow Jones, 30 large companies. It's old and kind of arbitrary, but people still pay attention to it. The NASDAQ, tech-heavy index. If you want to know how tech stocks are doing, watch this. Most individuals shouldn't try to pick individual stocks because you're competing against professional investors with better information, better tools, and more time. Instead, most people should buy index funds, funds that own a little bit of everything in an index. You get diversification, low fees, and you'll probably outperform most professional investors. Warren Buffett, one of the greatest investors ever, recommends that normal people just buy S&P 500 index funds and forget about it. If the world's best investor says you shouldn't try to beat the market, maybe listen to him instead of your brother-in-law who swears he's figured out a pattern. Chapter 16. Bonds. Boring but important bonds are the opposite of exciting, which is exactly why they're important. A bond is basically an IOU. When you buy a bond, you're lending money to a company or government. They promise to pay you back with interest. It's less risky than stocks because you're guaranteed to get your money back, unless the borrower defaults. But the returns are lower. Governments issue bonds to fund operations. The U.S. Treasury issues bonds that are considered among the safest investments in the world because the U.S. government has never defaulted and can theoretically always print money to pay its debts, though that would cause other problems. Companies issue bonds to raise money for expansion or operations. Corporate bonds are riskier than government bonds, but pay higher interest to compensate. The bond market is actually bigger than the stock market, but it gets way less attention because watching bond prices change is about as exciting as watching paint dry. But bond markets matter because they set interest rates. When bond prices go down, yields go up, which affects all other interest rates in the economy. Mortgages, car loans, business loans, they all move based partly on what's happening in the bond market. They signal economic expectations. When investors buy lots of government bonds, it means they're worried about the economy and want safe investments. When they sell bonds to buy stocks, it means they're optimistic. They fund government deficits. When the government spends more than it collects in taxes, which is pretty much always, it has to borrow the difference by issuing bonds. Who buys these bonds? Investors, foreign governments, and the Federal Reserve. There's a weird relationship between stocks and bonds. Usually when stocks go up, bonds go down, and vice versa. This is because investors move money between them based on which offers better returns, but sometimes they both go down, which is called a risk-off environment, and means investors are panicking and putting money under their mattresses. Chapter 17. Derivatives. Financial weapons of mass destruction. Now we get into the weird stuff. Derivatives. A derivative is a financial contract whose value is based on something else, usually a stock, bond, commodity, or index. It's called a derivative because its value derives from an underlying asset. The most common derivatives are options, contracts that give you the right but not the obligation to buy or sell something at a specific price. You might buy an option to purchase Apple stock at $150. If the stock goes to $200, you can exercise your option, buy at $150, and immediately sell at $200 for a nice profit. If the stock stays below $150, you just let the option expire and you only lose what you paid for the option itself. Futures, contracts that obligate you to buy or sell something at a future date at a predetermined price. Farmers use these to lock in prices for their crops. Speculators use these to bet on price movements. Swaps, agreements to exchange cash flows. Interest rate swaps let you trade fixed rate payments for variable rate payments or vice versa. Derivatives serve legitimate purposes. They let businesses hedge risk. A company that needs to buy a lot of oil can use futures to lock in prices and avoid getting destroyed if oil prices spike. An investor can use options to protect against a stock market crash. But derivatives also let you make massive leveraged bets with very little money down. This is how you get situations where someone loses billions of dollars on bets they made with millions. The leverage amplifies everything, both gains and losses. Warren Buffett called derivatives financial weapons of mass destruction, and he was proven right in 2008 when derivatives tied to mortgages nearly destroyed the global financial system. Here's what happened. Banks made lots of mortgages, including many to people who couldn't really afford them. Then they bundled these mortgages into securities called mortgage-backed securities and sold them to investors. Then other firms created derivatives based on these securities. You could bet on whether the mortgages would be paid back or default. When housing prices crashed and people couldn't pay their mortgages, the whole house of cards collapsed. The derivatives amplified the problem because they were so complex and interconnected that nobody knew who was on the hook for what losses. Banks stopped trusting each other, lending froze, and the economy nearly imploded. The government had to bail out major financial institutions to prevent a complete collapse. This made everyone very angry because the banks that created the problem got rescued while regular people who lost their homes and jobs didn't get nearly as much help. We supposedly fixed the regulations to prevent this from happening again. Whether those fixes will work the next time is something we'll find out during the next financial crisis. Section 6. Government's Role. When the Invisible Hand Needs Help. Chapter 18. Taxes. The Price of Civilization, or highway robbery, depending on who you ask. Let's talk about everyone's favorite topic, taxes. Taxes are how the government funds itself. Without taxes, there's no military, no roads, no public schools, no Medicare, no national parks, and no one to make sure your food isn't poisoned. So taxes are kind of necessary, even though nobody enjoys paying them. The U.S. collects about $4.9 trillion in taxes annually across federal, state, and local governments. That's a lot of money, and it comes from several sources. Income tax is the big one. The federal government taxes your income using a progressive system, which means the more you make, the higher percentage you pay. This sounds simple until you actually look at the tax code, which is 70,000 pages of rules, exemptions, deductions, and loopholes that ensure nobody actually understands how taxes work, including the IRS employees you call for help. Tax brackets work like this. You don't pay the top rate on all your income. You pay different rates on different chunks. If you make $100,000, you pay 10% on the first $11,000, 12% on the next chunk, 22% on the next chunk, and so on. People often don't understand this and think that making more money could push them into a higher bracket and leave them with less money overall. That's not how it works. Making more money always leaves you with more money, just not as much more as you'd hope. The top federal income tax rate is currently 37%, which sounds high until you learn that in the 1950s it was 91%. Rich people didn't actually pay 91% because of deductions and loopholes, but still, taxes used to be way higher. Payroll taxes fund Social Security and Medicare. You pay 7.65% of your wages, your employer pays another 7.65%, and this goes into trust funds that pay for old people's retirement and health care. If you're self-employed, you pay both halves, which is 15.3% and deeply annoying. Social Security is currently paying out more than it's taking in, which means it's slowly running out of money. The trust fund is projected to be depleted by 2034, at which point benefits will have to be cut unless Congress does something. They probably won't do anything until the absolute last minute because politicians hate making hard choices, so expect a crisis in about 10 years. Corporate taxes are taxes on business profits. The rate is currently 21%, down from 35% before the 2017 tax cuts. Companies pay tax on their profits, but they're very good at finding ways to reduce those profits through deductions, credits, and creative accounting. Large corporations often pay much less than 21% in effective taxes. Amazon famously paid zero federal income tax in 2018 despite making $11 billion in profit. They did this through completely legal tax strategies like carrying forward losses from previous years and taking advantage of R&D tax credits. It's legal, but it makes people very angry. Capital gains taxes are taxes on investment profits. If you buy stock for $1,000 and sell it for $2,000, you pay tax on the $1,000 gain. The rate is lower than income tax rates, either 0%, 15%, or 20%, depending on your income, because supposedly we want to encourage investment. This is how Warren Buffett ends up paying a lower tax rate than his secretary. Most of his income comes from capital gains, which are taxed at 20%, while his secretary's income is wages, which are taxed at higher rates. Sales taxes are charged when you buy stuff. Most states have them, usually 5 to 10%. The poor pay a higher percentage of their income in sales taxes because they spend most of their income on consumption, while the rich save and invest a lot of theirs. Property taxes are based on the value of real estate you own. They fund local services like schools, police, and fire departments. If you've ever wondered why people in rich neighborhoods have better schools, this is why. Property taxes are higher in expensive areas, so those schools get more funding. The U.S. tax system is supposed to be progressive. The rich pay a higher percentage than the poor. In practice, when you account for all taxes, federal, state, local, sales, property, it's only mildly progressive. The top 1% pays about 30% of their income in total taxes, while the middle class pays about 25%. It's more progressive than that sounds because the top 1% has so much income that their 30% represents a massive amount of tax revenue. Here's the thing about taxes that makes everyone angry. They're a political football. Conservatives want lower taxes, especially on businesses and the wealthy, arguing this encourages investment and growth. Liberals want higher taxes on the rich to fund social programs and reduce inequality. Both sides have legitimate points. Both sides also exaggerate their positions, and neither side wants to admit that the optimal tax policy probably involves compromises that would make both sides unhappy. Chapter 19: Government Spending, Where Your Tax Money Goes. So the government collects all these taxes. What does it do with the money? The federal government spends about $6.5 trillion per year. Yes, that's more than the $4.9 trillion it collects in taxes. We'll get to that problem in a minute. Here's where the money goes. Social Security, $1.2 trillion. Monthly checks to retirees and disabled people. This is the biggest single program, and it's extremely popular because old people vote and they really like getting their checks. Medicare, $900 billion. Healthcare for people over 65. Also, very popular for the same reason. Medicaid, $600 billion. Healthcare for poor people. Less politically popular because poor people vote less, but still hard to cut because nobody wants to be the person who took healthcare away from sick children. Defense, $800 billion. The military, which is larger than the next 10 countries' militaries combined. We have aircraft carriers, nuclear submarines, fighter jets, tanks, and a really expensive plane, the F-35, that still doesn't work properly after 20 years and $1.7 trillion in development costs. Why do we spend so much on defense? Partly because we're trying to maintain global military dominance, partly because defense contractors are very good at lobbying, partly because military bases provide jobs in congressional districts, so politicians support defense spending to bring jobs home, and partly because Americans generally support having a strong military, even if they don't always agree on what to use it for. Interest on the debt, $640 billion, just the interest payments on money we've already borrowed. This number keeps going up and crowds out spending on other things. More on this soon. Everything else, about $2.4 trillion. This includes veterans' benefits, education, transportation, science, agriculture, energy, foreign aid, and everything else the government does. That everything else category is only about 37% of the budget. The rest is Social Security, Medicare, Medicaid, defense, and interest payments. This is why it's so hard to cut spending. The big ticket items are politically untouchable, and cutting the smaller programs doesn't save enough money to matter. Oh, and foreign aid, which Americans think is a huge part of the budget. It's less than 1%. We spend more on military bans than we do on foreign aid. But people love to complain about it because helping other countries is less popular than helping ourselves, even though most foreign aid actually serves American interests. Chapter 20. The Deficit and the Debt. The bill we're leaving for future generations. Remember how the government spends $6.5 trillion but only collects $4.9 trillion? That $1.6 trillion difference is called the deficit. Every year's deficit adds to the national debt, which is the total amount the government owes. Right now, the national debt is about $34 trillion. That's $34 trillion. It's bigger than the entire economy. Is this a problem? Depends on who you ask. The This Is Fine camp argues that government debt isn't like household debt. The government can always borrow more and never has to fully pay it back, just refinance it. As long as the economy grows, the debt to GDP ratio is what matters, not the absolute number. Interest rates are low, well, they were until recently, so borrowing is cheap. Government spending during recessions prevents depressions, and the deficit is worth it. The "we're doomed" camp argues that this level of debt is unsustainable and will eventually cause a crisis. Interest payments are already eating up a huge chunk of the budget and will only get worse. We're borrowing from future generations to pay for current spending, which is immoral. At some point, investors will lose confidence and stop buying U.S. bonds, causing interest rates to spike and the economy to collapse. The truth is probably somewhere in between. Deficits during recessions and emergencies are fine and necessary. Running massive deficits when the economy is doing well is more problematic because you're not building up reserves for the next crisis. The debt becomes a serious problem when interest rates rise, making the debt more expensive to service. Investors lose confidence in the government's ability to pay. The debt crowds out productive investment in the private sector. Inflation takes off because the government prints money to pay debts. We're not in crisis yet, but we're heading in a concerning direction. Neither political party wants to address it because the solutions are politically toxic. Raise taxes, unpopular, or cut spending on popular programs, also unpopular. So we keep kicking the can down the road and hoping future politicians will deal with it. Spoiler, they won't. Chapter 21. Fiscal Policy. When the government tries to fix the economy. Fiscal policy is when the government uses spending and taxes to influence the economy. When the economy is in recession, people aren't spending, businesses aren't investing, unemployment is high, the government can step in and stimulate demand. How? Increase government spending, build infrastructure, hire people, buy goods and services. This puts money in people's pockets, which they spend, which creates demand, which encourages businesses to produce more and hire more people. The spending multiplies through the economy, cut taxes, people have more money in their pockets, which they spend, same effect as above, send everyone checks, like the stimulus payments during COVID. People get money, they spend it, demand increases, economy recovers. In theory, this is called expansionary fiscal policy, and it's based on ideas from John Maynard Keynes, who figured out during the Great Depression that sometimes the government needs to spend money to get the economy moving again. The opposite is contractionary fiscal policy. Raise taxes, cut spending, which you do if the economy is overheating and inflation is getting out of control. Nobody likes contractionary fiscal policy because it means less money for everyone, so it rarely happens. Fiscal policy has some problems. Timing. By the time Congress debates, passes, and implements a spending bill, the recession might be over. Government moves slowly. Politics. Decisions about spending and taxes are made by politicians who care more about getting re-elected than about optimal economic policy. This leads to spending on programs that benefit their constituents rather than programs that would help the economy most, crowding out. When the government borrows a lot of money to fund spending, It competes with businesses for available funds, which can push up interest rates and reduce private investment. Debt. Fiscal stimulus means borrowing more money, which adds to the national debt. At some point, this becomes unsustainable. During the 2008 financial crisis, the government passed a $787 billion stimulus package. It probably prevented the recession from being much worse, though economists debate how effective it was. Some say it was too small, some say it was poorly targeted, some say it worked great. During COVID, the government spent trillions on stimulus, extended unemployment benefits, small business loans, direct payments to households. This prevented a complete economic collapse, but also contributed to the inflation we experienced afterwards, when demand recovered faster than supply. Fiscal policy is a blunt instrument. It's like trying to perform surgery with a hammer. Sometimes it works, sometimes you just make a mess, and you won't know which until years later when economists analyze the data and argue about it. Chapter 22, Monetary Policy, the Fed's Magical Interest Rate Lever. While fiscal policy is the government's tool, monetary policy is the Federal Reserve's tool. Remember, the Fed controls the money supply and sets interest rates. This is how they try to keep the economy stable. Not too hot, not too cold, just right. When the economy is in recession, the Fed lowers interest rates. Borrowing becomes cheaper, so businesses invest more and consumers spend more. Buys bonds, called quantitative easing. This injects money into the economy and lowers long-term interest rates, encourages lending, lower reserve requirements for banks, making it easier for them to lend money. When inflation is too high and the economy is overheating, the Fed raises interest rates. Borrowing becomes more expensive, which slows down spending and investment. Sells bonds. This takes money out of the economy, tightens regulations, makes it harder for banks to lend. The Fed's main tool is the federal funds rate, the rate banks charge each other for overnight loans. When the Fed changes this rate, it ripples through the entire economy. Mortgage rates change, car loan rates change, credit card rates change, business loan rates change. The Fed tries to balance two goals: maximum employment, keep unemployment low price stability, keep inflation around 2%. These goals sometimes conflict. Lowering unemployment often increases inflation. Fighting inflation often increases unemployment. The Fed has to find the balance, which is part art, part science, and part guessing. After the 2008 financial crisis, the Fed lowered interest rates to basically zero and kept them there for years. This was supposed to be emergency policy, but it became the new normal because the economy was weak for a long time. Then COVID hit, and the Fed lowered rates to zero again and started buying trillions in bonds to keep credit flowing. This helped prevent a depression, but also contributed to inflation when the economy recovered. In 2022 to 2023, when inflation hit 9%, the highest in 40 years, the Fed raised interest rates aggressively, from near zero to over 5% in less than 2 years. This was the fastest increase in decades. The goal was to cool down the economy and bring inflation back to 2%. The side effect? Higher mortgage rates, more expensive car loans, harder for businesses to borrow and expand. The Fed was essentially trying to slow down the economy on purpose to fight inflation, and they had to do it without triggering a recession. It's like trying to land a plane in a windstorm while the passengers are screaming at you and half of them think you should speed up while the other half thinks you should slow down. Monetary policy works faster than fiscal policy because the Fed can act immediately without congressional approval, but it's also less precise. Interest rate changes affect the entire economy in complex ways, and sometimes the effects take months or years to fully play out. Chapter 23, Regulation, the Rules of the Game. Let's talk about regulation, which is when the government tells businesses, you can't do that, or you have to do it this way. In a completely free market with no rules, businesses would do whatever maximizes profit. Sell dangerous products? Sure, if people buy them. Dump toxic waste in rivers? Why not? It's cheap. Form monopolies and crush competition? Absolutely. This is why we have regulations. They're the rules that prevent the worst outcomes of unconstrained capitalism. Environmental regulations stop companies from poisoning the air and water. Before the Clean Air Act, Los Angeles had smog so thick you couldn't see across the street. Rivers caught on fire. Now things are much better, though still not perfect. Safety regulations ensure products won't kill you. The FDA makes sure your food and medicine are safe. The CPSC recalls dangerous products. OSHA sets workplace safety standards so your boss can't make you work in a death trap. Financial regulations try to prevent another 2008-style meltdown. Banks have to keep certain reserves, can't make certain risky bets, and have to be transparent about their finances. Whether these regulations actually work is something we'll find out during the next financial crisis. Labor regulations set minimum wages, overtime rules, child labor laws, and anti-discrimination protections. Before these existed, children worked in factories, employees worked 16-hour days with no overtime, and discrimination was completely legal. Antitrust regulations prevent monopolies and promote competition. These have been enforced inconsistently. We broke up Standard Oil and AT&T, but let tech companies get enormous without much pushback. The debate over regulation is one of the biggest divides in economic policy. Pro-regulation folks argue that markets fail in predictable ways, and regulation corrects these failures. Without regulation, businesses externalize costs onto society: pollution, unsafe products, worker exploitation. Some things are too important to leave to markets: healthcare, environmental protection, financial stability. Regulation creates a level playing field and prevents a race to the bottom. Anti-regulation folks argue that regulation is inefficient and creates deadweight loss. Businesses know how to run themselves better than bureaucrats do. Compliance costs hurt small businesses more than large ones. Regulation gets captured by the industries it's supposed to regulate, making it ineffective or counterproductive. Innovation is stifled by excessive rules. The truth is that some regulation is necessary and some is excessive, but nobody agrees on where to draw the line. Every regulation looks different depending on whether you're the one being regulated or the one being protected. Also, regulations have a life cycle. A crisis happens, regulations get passed, time passes, people forget why the regulations existed, lobbying weakens enforcement, rules get repealed, another crisis happens, and the cycle repeats. We deregulated the financial sector in the 1990s, believing that markets could regulate themselves. That worked great until 2008, when it turned out markets cannot in fact regulate themselves and the global economy nearly collapsed. So we passed new regulations. Now those regulations are being weakened again because people have short memories and bank lobbyists have long attention spans. History doesn't repeat, but it definitely rhymes. Section 7. Trade and Globalization. Why Everything Comes from China. Chapter 24. International Trade. The original globalization trade between countries has existed for thousands of years, but it's become the backbone of the modern economy. Right now, the shirt you're wearing was probably made in Bangladesh, your phone in China, your coffee in Colombia, and your existential dread is homegrown and organic. Why do countries trade? The same reason people trade: specialization and comparative advantage. Absolute advantage is when a country can produce something more efficiently than another country. Maybe the US can produce both computers and wheat more efficiently than Mexico. You'd think this means the US shouldn't trade with Mexico at all, but that's wrong. And this is where comparative advantage comes in. One of the most important and most misunderstood concepts in economics. Comparative advantage says that even if you're better at everything, you should still specialize in what you're most best at and trade for the rest. Here's an example. Imagine a lawyer who's the best lawyer in town and also the fastest typist. Should the lawyer do their own typing? No. Even though they're better at typing than any secretary, their time is more valuable spent practicing law. They should hire a secretary for typing and focus on law, even though they could do both jobs better than anyone else. Countries work the same way. Maybe the US could make everything more efficiently than other countries, but US workers are so productive that it makes more sense for them to focus on high-value stuff like technology and finance, while importing lower-value stuff like textiles from countries where labor is cheaper. Everybody benefits from this. The US gets cheaper clothes and can focus on high-value production. The other country gets jobs and income from making clothes. Total global production increases, and in theory, everyone is better off. In theory. Chapter 25. Winners and Losers of Trade. Here's the uncomfortable truth about trade. Overall, it creates more winners than losers, but the winners and losers aren't the same people. Trade makes goods cheaper. Your phone costs $1,000 instead of $5,000 because it's assembled in China using parts from 12 different countries, each specializing in what they're good at. You benefit every time you buy cheap imported goods. Businesses benefit when they can sell to global markets instead of just domestic ones. Apple sells iPhones worldwide. Boeing sells planes to foreign airlines. Hollywood movies earn more overseas than domestically. Trade expands their markets and increases profits. Consumers benefit from variety. You can buy Japanese cars, Swiss chocolate, French wine, and Italian shoes without leaving your country. Trade gives you options. But some people lose. Manufacturing workers whose jobs moved overseas lost their livelihoods. If you worked in a furniture factory in North Carolina and your factory closed because furniture is now made in Vietnam for 1/3 the cost, trade didn't help you. It destroyed your career. The economic argument is that displaced workers should retrain for new jobs in growing industries. In practice, this is really hard. A 50-year-old factory worker doesn't easily become a software engineer. Retraining programs exist, but often don't work well. And even if you retrain, the new job might pay less and be in a different city, requiring you to uproot your life. This is why trade is so politically controversial. Economists can show that trade increases overall welfare, but overall welfare doesn't help the individual worker whose factory closed. The benefits of trade are diffuse. Everyone saves a little money on consumer goods. The costs are concentrated. Specific communities lose their major employers and crater economically. When economists say trade is good, they mean, in aggregate, the gains outweigh the losses. But if you're one of the losses, that's cold comfort. Chapter 26. Trade deficits. Are they bad? The US runs a massive trade deficit. We import about $1 trillion more in goods than we export every year. This makes a lot of people angry. A trade deficit means we're buying more from other countries than they're buying from us. We send them dollars, they send us stuff. Sounds bad, right? Not necessarily. Here's the thing. Those dollars come back to us. They have to. What else are foreign countries going to do with dollars? They can buy American goods and services. This is exports, which reduces the deficit. Invest in American assets. Buy stocks, bonds, real estate, businesses. Most of the time, they do option 2. China has a massive trade surplus with us. They take those dollars and buy US Treasury bonds, so we get their products, they get our IOUs. Is this bad? Again, it depends. On one hand, we get to consume more than we produce. We import consumer goods and use our workforce for service sector jobs. We get cheap stuff and they get pieces of paper promising future payment. On the other hand, we're financing our consumption with debt. We're selling off assets to fund current spending. If this continues indefinitely, eventually foreigners will own a lot of American assets, and will owe them a lot of money. Also, trade deficits can indicate underlying problems. Americans save too little and consume too much. American manufacturing has become uncompetitive. The dollar is overvalued, making our exports expensive and imports cheap. Or trade deficits might just mean the US is a good place to invest, so foreign countries want to put their money here, which requires running a trade deficit to balance the flows. Economists debate this endlessly. Some think trade deficits are fine, some think they're destroying American industry. Both sides have valid points and selectively cite data that supports their view. What's clear is that trade deficits are more complicated than they sound, and treating them as simply good or bad misses important nuances. Chapter 27. The dollar. Reserve currency privilege. Here's something wild. The US dollar is the world's reserve currency. This gives America superpowers. A reserve currency is what central banks hold as reserves and what international transactions are conducted in. Oil is priced in dollars. International debt is denominated in dollars. When countries trade with each other, they often settle in dollars, even if neither country is the US. Why the dollar? The US has the largest, most stable economy, US. Financial markets are deep and liquid. The US has strong property rights and rule of law historical momentum. It's been this way since World War II. This gives the US enormous advantages. We can print money that the world wants. When the Fed creates dollars, foreigners accept them as payment. Try that with Argentine pesos and see how it goes. We can borrow cheaply. The whole world wants safe dollar-denominated assets, which means demand for US Treasury bonds is huge, which keeps interest rates low. We can run trade deficits indefinitely. We send other countries dollars. They're happy to hold them. So the game continues. We can impose financial sanctions. If you want to do business internationally, you need dollars, which means you need access to the US financial system. If the US cuts you off, you're isolated from global commerce. This is a powerful geopolitical weapon, but reserve currency status also has downsides. It makes exports expensive. Global demand for dollars keeps the dollar strong, which makes American goods expensive for foreigners to buy, hurting exporters and manufacturing. It enables bad habits. Easy borrowing lets the government run bigger deficits than it otherwise could. It creates obligations. The US has to supply the world with dollars, which means running trade deficits, even if we'd prefer not to. The dollar's dominance isn't guaranteed forever. The euro challenged it but has problems of its own. China wants the yuan to be a reserve currency, but needs to make it freely convertible and open up its financial system first, which the Communist Party is reluctant to do. For now, the dollar remains king, but empires don't last forever, and neither do reserve currencies. 8:51 p.m. section. 8. Economic Challenges and the Future. Chapter 28. Inequality. When the pie grows but you don't get a bigger slice. Let's talk about something uncomfortable. Inequality. The American economy has grown massively over the past 50 years. GDP has more than tripled. Productivity has skyrocketed. Corporate profits are at record highs. The stock market keeps hitting new peaks, but most Americans don't feel richer, and that's because they aren't. Since the 1970s, wages for the bottom 90% of workers have barely grown when adjusted for inflation. Meanwhile, incomes for the top 10% have doubled, and incomes for the top 1% have tripled. The top 0.1% have seen their incomes increase by 400%. Right now, the top 1% of Americans own about 32% of all wealth. The bottom 50% own about 2%. The three richest Americans have more wealth than the bottom 50% of the entire country combined. This isn't just a moral issue, it's an economic issue. High inequality creates problems. Reduced social mobility. The American dream was that anyone could work hard and get ahead, but if you're born poor, you're likely to stay poor. The US now has lower social mobility than most European countries. Being born to rich parents is a better predictor of your future income than your grades, work ethic, or talent. Unstable. Economy. When wealth is concentrated at the top, consumption becomes dependent on the spending patterns of a small group. The wealthy save more and spend less of their income. The poor would spend money if they had it, but they don't. This dampens overall demand and makes the economy more fragile. Political problems. Wealthy people have more political influence. They can donate to campaigns, hire lobbyists, and shape policy in ways that benefit them. This creates a feedback loop. Economic power translates to political power, which creates policies that increase economic power. Social problems. High inequality correlates with worse health outcomes, lower life expectancy, higher crime rates, lower trust, and more social conflict. Unequal societies are generally unhappier and more dysfunctional. So why has inequality increased so much? Globalization and trade. Manufacturing jobs that paid middle-class wages moved overseas. Workers who once made decent money in factories now work in lower-paid service jobs. Technology. Automation replaced many middle-skill jobs. Technology increases returns to highly skilled workers. Software engineers make bank, while reducing demand for routine cognitive and manual labor. Decline of unions. Union membership has fallen from 35% in the 1950s to about 10% today. Unions used to give workers bargaining power to demand higher wages and better benefits. Without unions, workers have less leverage. Tax policy. Top marginal tax rates have fallen from 70% in the 1970s to 37% today. Capital gains taxes, which primarily affect the wealthy, are lower than income taxes. Estate taxes have been reduced. The tax code has become less progressive. Corporate power. Companies have more monopoly power, which lets them pay workers less and charge consumers more. Antitrust enforcement has been weak. Winner-take-all dynamics. In many fields, the best performers capture most of the rewards. The best programmer, lawyer, or entertainer can serve global markets and earn vastly more than someone slightly less talented. Technology amplifies this effect. Housing costs. In productive cities where good jobs are, housing has become absurdly expensive due to restrictive zoning and NIMBY, not in my backyard, policies. This transfers wealth from young workers to older homeowners and makes it harder to move to where opportunities are. What can be done about inequality? That's a political question with no easy answers. Raise minimum wages, strengthen unions, increase taxes on the wealthy, invest more in education, break up monopolies, universal basic income, more progressive tax system, reform housing policy. Every solution has trade-offs and faces political opposition. Meanwhile, inequality keeps growing, social cohesion keeps deteriorating, and the economy becomes more unstable. Chapter 29: Recessions and Booms. The Business Cycle. The economy doesn't grow smoothly. It cycles through periods of expansion and contraction, growth and recession, boom and bust. This is called the business cycle, and it's been happening for as long as market economies have existed. A recession is when the economy shrinks for 2 consecutive quarters. GDP falls, unemployment rises, businesses fail, the stock market crashes, and everyone gets depressed, both economically and emotionally. An expansion is when the economy grows. Jobs are plentiful, wages rise, businesses invest, the stock market goes up, and everyone forgets that recessions exist and starts making risky financial decisions. Why does the economy cycle instead of just growing steadily? Theory 1: overinvestment. During booms, businesses get optimistic and invest too much. They build too many factories, hire too many workers, produce too much stuff. Eventually, they realize they've overexpanded, so they cut back, which causes a recession. Theory 2: credit cycles. During expansions, credit is easy to get. Banks lend freely. People borrow to buy houses and cars and start businesses. Debt levels rise. Eventually, debt becomes unsustainable, lending tightens, spending collapses, and recession hits. Theory 3: monetary policy. The Fed tries to manage the economy, but their tools are imprecise. They keep interest rates low to encourage growth, but this can cause inflation and asset bubbles. Then they raise rates to cool things down, but they might overdo it and trigger a recession. Theory 4: external shocks. Sometimes recessions just happen because of unexpected events. Oil price spikes, pandemics, financial crises, wars. The economy is hit by something it can't immediately adjust to, and recession follows. Theory 5: psychology and animal spirits. People's mood affects the economy. When everyone's confident, they spend and invest, which creates growth. When everyone's fearful, they save and cut back, which creates recession. These shifts in sentiment can be self-fulfilling. The truth is probably some combination of all of these. Recessions are painful but might be necessary. They clear out inefficient businesses, deflate bubbles, reduce debt levels, and reset the economy for the next expansion. Joseph Schumpeter thought recessions were healthy creative destruction. Of course, this is easier to say when you're an economist with a stable job than when you're unemployed and losing your house. The U.S. has had 13 recessions since World War II. Some were mild, 2001, some were severe, 2008. On average, the economy spends about 15% of the time in recession and 85% in expansion. The longest expansion in U.S. history was from 2009 to 2020. 128 months of continuous growth. Then COVID hit and caused the shortest, deepest recession on record. 2 months of economic freefall followed by a rapid recovery fueled by unprecedented government spending. Nobody can predict exactly when the next recession will hit. Economists have predicted 9 of the last 5 recessions. As the joke goes, markets try to predict recessions and sometimes cause them through self-fulfilling prophecy. The Fed tries to prevent them but sometimes causes them by raising rates too much. The business cycle is one of those features of capitalism that we accept because we don't have a better alternative. We've gotten better at managing it. Recessions are less frequent and less severe than they used to be, but we haven't eliminated it. And honestly, given how the economy works, we probably never will. Chapter 30: Automation and AI. Are robots coming for your job? Let's talk about the thing keeping futurists up at night: automation. For 200 years, people have worried that machines would take all the jobs, and for 200 years, they've been both right and wrong. Machines did take jobs. Tractors replaced farm workers. Robots replaced factory workers. ATMs replaced bank tellers. Self-checkout replaced cashiers. Every technological advance eliminates some jobs. But the economy created new jobs. When agriculture automated, people moved to manufacturing. When manufacturing automated, people moved to services. Farmers became factory workers. Factory workers became nurses, teachers, programmers, and baristas. The economy shifted, sometimes painfully, but employment didn't disappear. In fact, we have more jobs now than ever before, just different ones. But this time might be different, and that's because of artificial intelligence. Previous automation replaced physical labor and routine cognitive tasks. AI can replace non-routine cognitive tasks, the kind that currently require human judgment, creativity, and expertise. Truck drivers? Autonomous vehicles are coming. Radiologists? AI can read X-rays better than humans. Lawyers? AI can review documents faster and cheaper. Writers? Have you seen ChatGPT? Customer service? Automated? Basic coding? AI can do it. Even some creative work, art, music, writing, can now be partially automated. This is different from previous technological waves because it's targeting skilled middle-class jobs, the jobs that were supposed to be safe from automation. There are three possible futures. Optimistic scenario. AI augments human workers rather than replacing them, just as calculators made mathematicians more productive rather than obsolete. AI makes knowledge workers more productive. New industries emerge that we can't imagine yet, creating new jobs. Universal prosperity increases as productivity soars. Pessimistic scenario. AI replaces vast numbers of workers faster than new jobs can be created. Unemployment skyrockets. Wages collapse for remaining workers who now compete with AI. Wealth concentrates among owners of AI and capital. Society fractures into a small elite and a massive underclass. Governments struggle to maintain stability. Muddled middle scenario. AI replaces some jobs, creates others, and transforms most. There's significant disruption and pain during the transition. Some workers adapt and thrive. Others are left behind. Inequality increases. Government implements policies like universal basic income or job guarantees to manage the transition. Society adjusts, not smoothly, but eventually. Which scenario happens depends on how fast AI advances, how society chooses to distribute the gains from increased productivity, whether we implement policies to help displaced workers, whether new industries emerge to employ people, whether we redefine work and value in society. The economic argument for optimism is based on history. Technology has always created more jobs than it destroyed, but the counter-argument is that this time is different, because AI can do cognitive tasks that we thought required uniquely human capabilities. Also, even if the economy eventually creates new jobs, the transition could take decades. What happens to the 3.5 million truck drivers when autonomous vehicles arrive? Learn to code isn't a realistic answer for everyone. This is probably the biggest economic question of the next few decades. The decisions we make about AI, automation, education, and social policy will determine whether the future is broadly prosperous or deeply unequal. Chapter 31. Climate Change. The Economy versus the Planet. Here's an uncomfortable fact. Much of our economic growth over the past 200 years came from burning fossil fuels. Coal powered the Industrial Revolution. Oil powered the automobile age. Natural gas powers electricity generation. Fossil fuels are incredibly energy dense, easily transportable, and relatively cheap. They enabled an explosion of productivity and wealth. They're also cooking the planet. Carbon dioxide from burning fossil fuels is causing global temperatures to rise. This causes sea level rise, extreme weather, droughts, floods, heat waves, and ecosystem collapse. If left unchecked, climate change will cause trillions of dollars in economic damage and massive human suffering. So we have a problem. The economic system that created prosperity is also creating an existential threat. This is a massive externality, a cost imposed on others who weren't part of the transaction. When you drive a car, you pay for gas, but you don't pay for the climate damage from the emissions. That cost is borne by everyone, including people who don't drive and future generations who don't exist yet. Because individuals and businesses don't bear the full cost of carbon emissions, they produce too much of it. This is a market failure. The free market produces outcomes that are bad for society overall. How do we fix this? Carbon taxes. Make polluters pay for emissions. This internalizes the externality and creates incentives to reduce carbon use. Economists love this solution because it's market-based and efficient. Politicians hate it because tax is a bad word, and voters don't like paying more for gas. Cap and trade. Set a limit on total emissions and let companies trade pollution permits. This creates a market for carbon reduction and theoretically achieves climate goals at lowest cost. It's been tried with mixed success. Regulation, mandate emission standards, renewable energy requirements, vehicle efficiency rules. This is less efficient than carbon pricing but more politically feasible. Subsidies pay for renewable energy, electric vehicles, energy efficiency. This is expensive for taxpayers but creates green jobs and accelerates transition. Innovation, invest in technology like carbon capture, nuclear fusion, better batteries, hydrogen fuel. If we invent cheap, clean energy, we solve the problem without sacrifice. The challenge is that climate action has costs today, but benefits in the future. Politically, that's hard. People care more about their current expenses than about abstract future harms. Politicians care more about the next election than about climate in 2100. Also, it's a global problem requiring global cooperation. If the US reduces emissions but China and India don't, we still have a problem. But if everyone waits for everyone else to act first, nobody acts. The economic cost of climate change is hard to calculate but enormous. Some estimates suggest it could reduce global GDP by 10 to 25% by 2100 if we don't act. Coastal cities would flood. Agriculture would fail in many regions. Hundreds of millions would become climate refugees. The cost of preventing climate change is also large. Maybe 1 to 2% of global GDP per year. That's a huge amount of money, but a lot less than the cost of doing nothing. The economy versus the planet seems like a false choice. We need the economy to fund climate solutions. And we need climate stability for the economy to function long term. But in the short term, there are real trade-offs. Transitioning away from fossil fuels means stranded assets, job losses in coal and oil, higher energy costs during the transition. Politically, these concentrated costs often outweigh diffuse future benefits. Whether we solve climate change might be the ultimate test of whether humanity can cooperate to solve collective action problems. The track record so far is not great. Chapter 32, The Future of Work. What comes next? Let's peer into the crystal ball and think about where work is heading. The traditional model, get educated, find a stable job, work for 40 years, retire, is already breaking down for many people. What replaces it? Trend 1. The gig economy expands. More people work as independent contractors, freelancers, or in temporary positions. Full-time employment with benefits becomes less common. Workers have flexibility, but also insecurity. Trend 2. Remote work normalizes. COVID proved that many jobs can be done from anywhere. This lets workers live in cheaper areas while earning higher salaries. But it also means workers now compete globally, which could suppress wages. Trend 3. Continuous learning becomes essential. The half-life of skills keeps shrinking. What you learned in college is obsolete within years. Workers need to constantly retrain and adapt. Education becomes lifelong rather than front-loaded. Trend 4. Automation replaces routine work. Both physical and cognitive routine tasks get automated. The jobs that remain require creativity, emotional intelligence, complex problem-solving, and skills that are hard to automate. Trend 5. The labor market polarizes. High-skill, high-pay jobs grow. Low-skill, low-pay service jobs grow. Middle-skill, middle-pay jobs disappear. The economy becomes barbell-shaped rather than pyramid-shaped. Trend 6. Alternative work arrangements emerge. Maybe we move to shorter work weeks. Maybe we implement universal basic income. Maybe we create new forms of ownership like worker cooperatives. Maybe we redefine what counts as valuable work. Caring for family, community service, creative pursuits. Trend 7. Credentialism increases. As jobs become more competitive, employers demand more credentials. Entry-level jobs that used to require high school diplomas now require bachelor's degrees. Bachelor's degrees jobs now require master's degrees. Education becomes increasingly expensive, while its economic value becomes less clear. The optimistic future of work. Technology makes us so productive that we can work less while maintaining living standards. We have more time for family, hobbies, and pursuits that aren't economically valuable but are personally meaningful. Abundance allows us to focus on human flourishing rather than just survival. The pessimistic future. Most jobs get automated or moved to the lowest cost location. The benefits of productivity gains accrue to capital owners, while workers struggle for scraps. Work becomes precarious and poorly paid. We need government intervention just to maintain basic standards of living. Which future we get depends on choices we make about education, technology policy, labor law, tax policy, and what kind of society we want to build. The economy isn't a force of nature. It's a human creation that reflects our values and choices. If we don't like where it's heading, we can change it. Whether we will is a different question. Chapter 33, Measuring What Matters Beyond GDP. For decades, we've measured economic success with one number. GDP. GDP, gross domestic product, is the total value of all goods and services produced in a country. When GDP goes up, the economy is growing. When it goes down, we're in recession. Politicians brag about GDP growth. Economists track it obsessively. But GDP is a terrible measure of actual well-being. GDP counts things that make life worse. A car accident increases GDP. Ambulance services, hospital care, car repairs, insurance claims. A hurricane increases GDP because of reconstruction spending. Crime increases GDP through policing and prisons. If everyone gets cancer, GDP soars from medical spending. These are bad things that we're counting as economic growth. GDP doesn't count things that make life better. Unpaid care work, raising children, caring for elderly parents, doesn't count. Volunteer work doesn't count. Environmental quality doesn't count. Leisure time doesn't count. If a parent quits their job to care for their child full-time, GDP falls, even though the child is still being cared for and arguably better off. GDP doesn't measure distribution. If billionaires get richer while everyone else gets poorer, GDP might still grow. The country is richer on paper while most people are worse off. GDP doesn't measure sustainability. We can boost GDP by depleting natural resources, polluting the environment, and borrowing from the future. These activities increase current GDP while making future generations worse off. GDP doesn't measure happiness or life satisfaction. Research shows that beyond a certain point, around $75,000 to $100,000 per person, more GDP doesn't make people much happier. Relationships, health, purpose, and community matter more than marginal consumption increases. So why do we still use GDP? Because it's simple, measurable, and everyone understands it. It's hard to manage what you don't measure, and GDP is easy to measure. But there are alternatives. The Genuine Progress Indicator, GPI, adjusts GDP for inequality, environmental damage, and non-market activities. When you account for these factors, GPI in the US peaked in the 1970s and has been declining since, even as GDP tripled. The Human Development Index, HDI, combines life expectancy, education, and income. It captures more dimensions of well-being than GDP alone. Gross national happiness, seriously, Bhutan uses this, measures psychological well-being, health, education, culture, environmental conservation, and governance. The OECD Better Life Index tracks housing, income, jobs, community, education, environment, civic engagement, health, life, satisfaction, safety, and work-life balance. None of these are perfect, and all are harder to measure than GDP, but they capture more of what actually matters for human flourishing. The economist Robert Kennedy said it best in 1968, GDP measures everything except that which makes life worthwhile. Maybe it's time to measure what actually makes life worthwhile. Conclusion. So there you have it, how the American economy works. We've covered money, banks, jobs, businesses, trade, government policy, inequality, recessions, automation, climate change, and why GDP is a lying liar that lies. Here's the thing about the economy. It's not some abstract machine separate from human life. It's the system through which we organize production, distribute resources, and determine who gets what. Every decision about the economy is fundamentally a decision about values. What we think is fair, what we think is efficient, what kind of society we want to live in. The economy has lifted billions of people out of poverty. It's created unprecedented wealth and technological progress. It's given us smartphones, modern medicine, and the ability to have fresh strawberries in December. It's also created massive inequality, environmental destruction, and systems where Amazon warehouse workers pee in bottles while Jeff Bezos builds penis-shaped rockets to space. Both of these things are true simultaneously, and anyone who tells you the economy is purely good or purely bad is selling you something. The debates we have about economic policy, taxes, spending, regulation, trade, labor law, monetary policy are really debates about what kind of society we want. Do we prioritize efficiency or equality? Growth or sustainability? Individual freedom or collective welfare? Innovation or stability? These aren't questions that economics alone can answer. Economics can tell us the trade-offs, but it can't tell us what we should value. That's a human question, not a mathematical one. The American economy is the largest, most complex, most dynamic economic system in human history. It's capable of extraordinary innovation and adaptation. It's also capable of extraordinary cruelty and short-sightedness. Where it goes from here depends on the choices we make, about technology, about policy, about how we organize work and distribute prosperity. The economy isn't destiny, it's a choice. Choose wisely. And maybe, just maybe, next time someone at a party starts talking about macroeconomic indicators and fiscal multipliers, you'll actually know what they're talking about. Or more likely, you'll realize they don't know what they're talking about, and you can call them out on it. Either way, you're welcome. Bonus section: the stuff they don't teach you in economics class. Chapter 34: Shadow Banking, the financial system's evil twin. Let's talk about shadow banking, which sounds like something from a Batman movie, but is actually way more dangerous. You know how regular banks take deposits, make loans, and are heavily regulated? Shadow banking is all the banking-like activities that happen outside that regulated system. Shadow banks include hedge funds that pool money from wealthy investors and make risky bets, private equity firms that buy companies using mostly borrowed money, money market funds that look like bank accounts but aren't insured, investment banks that don't take deposits but do everything else banks do, special purpose vehicles that exist only to hide debt off corporate balance sheets. Shadow banking grew massively in the 2000s because regular banking was boring and regulated. Why accept 3% returns on safe investments when you can make 30% in the shadows? What could go wrong? Everything, as it turns out. In 2008, the shadow banking system was larger than the regular banking system, about $20 trillion compared to $13 trillion in traditional bank deposits. These institutions were lending money, creating credit, and taking huge risks, but they didn't have to follow banking regulations. They didn't have deposit insurance. They didn't have the Fed as a backstop. They were operating on the assumption that if anything went wrong, they'd be bailed out anyway. They were right about the bailout part, which is probably the most infuriating aspect. Here's how shadow banking works in practice. A hedge fund borrows $90 for every $10 it has from investors. This is called leverage, and it's how you turn modest gains into huge profits, or modest losses into catastrophic disasters. The hedge fund uses this borrowed money to buy mortgage-backed securities, which are bundles of home loans packaged together and sold as investments. These securities were rated AAA, super safe, by credit rating agencies that were paid by the companies creating the securities, which is definitely not a conflict of interest, no sir. The hedge fund then uses these safe securities as collateral to borrow even more money, which it uses to buy more securities, which it uses to borrow more money, in an infinite loop of leverage that makes your head spin. When housing prices were going up, everyone made money. When housing prices stopped going up, the whole system imploded like a dying star. Lehman Brothers, a major investment bank, had leverage ratios of 30 to 1. They had $30 of assets for every $1 of actual capital. When their assets dropped in value by just 3.3%, they were completely insolvent. They filed for bankruptcy in September 2008, which triggered the worst financial crisis since the Great Depression. The government let Lehman fail, thinking it would send a message about moral hazard. You take big risks, you face big consequences. Instead, it sent a message that the financial system was completely unstable, and panic ensued. The government then bailed out pretty much everyone else: AIG, Bear Stearns, Citigroup, Bank of America, at taxpayer expense. After 2008, regulators tried to rein in shadow banking through the Dodd-Frank Act. It worked, sort of. Shadow banking is smaller now and somewhat safer, but it still exists, and it's still doing risky things outside the view of regulators. Why does shadow banking exist? Because when there's money to be made and regulations in the way, finance finds a workaround. You can regulate banks all you want, but if banking-like activities can happen elsewhere, they will. It's like whack-a-mole, except the mole has lobbyists, and the hammer is held by underfunded regulators who often get recruited by the moles they're supposed to be whacking. Chapter 35. Central Bank Independence. Why politicians don't control money. Here's a weird quirk of American democracy. The most powerful economic institution isn't controlled by elected officials. The Federal Reserve is technically independent from the government. The president appoints Fed governors, but once appointed, they can't be fired. The Fed doesn't need congressional approval for its decisions. It funds itself from interest on its assets, so Congress can't defund it. Why would we design it this way? Isn't this anti-democratic? Yes, but also, there's a good reason. If politicians controlled monetary policy, they'd constantly mess with it for political gain. Facing an election? Lower interest rates to juice the economy, make people feel good, and win votes. Worry about inflation later. That's the next politician's problem. This is called the political business cycle, and it's disastrous. It creates boom-bust cycles driven by election timing rather than economic fundamentals. Argentina is a textbook example of what happens when central banks aren't independent. The government prints money to fund spending, causing massive inflation. They've had multiple currency collapses, hyperinflation episodes, and defaults on debt. People have to check prices multiple times per day because they're changing that fast. A steak that costs 1,000 pesos at lunch costs 1,200 pesos at dinner. This is what happens when politicians control the money printer. So most developed countries give central banks independence. The idea is that technocrats who don't face elections can make hard, unpopular decisions for the long-term good of the economy. But independence has downsides too. Accountability. If the Fed isn't accountable to voters, who is it accountable to? Theoretically, Congress can change the Fed's mandate, but in practice, the Fed operates with limited oversight. Elitism. The Fed is run by economists and financiers, mostly from elite institutions. They make decisions that affect everyone, but they're not representative of everyone. 9 unelected people on the Federal Open Market Committee have more influence over your financial life than most elected officials. Bias. Central bankers tend to be more worried about inflation than unemployment. They'll raise rates to fight inflation, even if it costs jobs. This reflects their class background and ideology. Wealthy people worry about inflation eroding their savings. Working people worry about losing their jobs. Capture. Even though the Fed is independent from politicians, it's not independent from the financial industry. Fed officials come from Wall Street and often return to Wall Street. This creates potential conflicts of interest and a worldview that prioritizes financial stability over other concerns. The debate over central bank independence intensifies during crises. In 2020, when the Fed was buying trillions in assets to support the economy, some argued they were overstepping their authority. In 2022 to 2023, when the Fed aggressively raised rates to fight inflation, causing unemployment to rise, others argued they were hurting workers to protect bondholders. There's no perfect answer. Democratic control of money leads to inflation and crisis. Technocratic control leads to legitimacy questions and potential bias. We've chosen technocratic control because the historical evidence suggests it's less bad, but least bad isn't exactly a ringing endorsement. Chapter 36. Why economics isn't a science, even though economists want it to be. Economists like to think they're scientists. They use math, build models, analyze data, make predictions. They call it economic science. But here's the dirty secret. Economics isn't really a science, and pretending it is causes problems. Real sciences, physics, chemistry, biology, can run controlled experiments. You can test hypotheses, isolate variables, and replicate results. If you claim water boils at 100 degrees Celsius, anyone can test this and get the same result. Economics can't do this. You can't run controlled experiments on the economy. You can't rewind history and try different policies to see what works. You can't isolate variables because everything affects everything else. When economists try to understand what caused a recession or whether a policy worked, they're looking at observational data, trying to separate correlation from causation and making assumptions that might be wrong. This is why economists disagree about everything. Did the 2017 tax cuts boost growth? Some economists say yes, some say no, and both cite data supporting their view. Does raising the minimum wage reduce employment? Some studies say yes, some say no, and the debate has raged for decades with no resolution. Was austerity the right response to the 2008 crisis, or should governments have spent more? Economists are still arguing about this 15 years later. The problem is that economic outcomes depend on human behavior, which is complex and unpredictable. People don't always act rationally. They're influenced by psychology, culture, institutions, and random events. You can't model this with precision. Also, the economy changes. A model that worked in 1960 might not work in 2024 because the economy is different. Different technology, different institutions, different global connections, and there's a reflexivity problem. Economic predictions can change behavior, which changes outcomes, which invalidates the prediction. If everyone believes a recession is coming, they cut spending, which causes a recession. The prediction became self-fulfilling. Despite these limitations, economists often present their findings with scientific certainty. They build mathematically sophisticated models that give precise predictions. But the precision is false. The models rest on assumptions that might not hold, and small changes in assumptions can completely change the results. This is called physics envy. Economists want the prestige and authority that comes from being a science, so they adopt the trappings of science without the substance. The danger is that policymakers treat economic models as more reliable than they are. A model says a policy will have certain effects, so we implement it, and then we're shocked when reality doesn't match the model. This doesn't mean economics is useless. Economic reasoning is valuable. Supply and demand are real. Incentives matter. Trade-offs exist. Economics provides frameworks for thinking about complex issues. But it's more like philosophy or history than physics. It's a way of thinking, not a source of precise predictions. The best economists are humble about the limits of their knowledge. The worst are overconfident charlatans who claim certainty where none exists. Learn to tell the difference. Chapter 37, Behavioral Economics. Turns out, humans are weird. Traditional economics assumes people are rational. We make decisions by calculating costs and benefits and choosing whatever maximizes our utility. We update our beliefs based on new information. We don't make systematic mistakes. This is obviously nonsense, and behavioral economics is the field that studies all the ways humans are predictably irrational. Example 1. Loss aversion. Losing $100 hurts way more than gaining $100 feels good. Rationally, these should feel equivalent in magnitude. But psychologically, losses loom larger than gains. This is why people hold on to losing stocks too long. Selling means realizing the loss, which is psychologically painful, so they hold and hope, even when selling would be the rational choice. Example 2. Anchoring. The first number you see influences your judgment, even if it's irrelevant. If a jacket is marked down from $200 to $100, you think you're getting a great deal. If it's just priced at $100 with no reference point, it seems expensive. The $200 anchor changed your perception, even though the actual price is the same. Example 3, present bias. We heavily discount the future. We'll choose $50 today over $100 next year, even though waiting is clearly the better deal. This is why people don't save for retirement, don't exercise, and eat dessert instead of vegetables. Future benefits feel abstract. Present pleasures feel real. Example 4. Sunk cost fallacy. You've spent $500 on a non-refundable vacation package. When it's time to go, you're sick and would rather stay home. Rationally, the $500 is gone whether you go or not, so you should decide based on whether you'd enjoy the trip in your current state. But most people go anyway because they already paid for it. They're letting a past cost that can't be recovered influence a future decision. Example 5. Framing effects. A medical treatment with a 90% survival rate sounds way better than one with a 10% death rate, even though they're identical. How information is presented completely changes decisions, even when the underlying facts are the same. Example 6. Herd behavior. Humans are social animals. We look at what others are doing and assume they know something we don't. This creates bubbles. Everyone's buying houses/stocks/Bitcoin, so it must be a good idea. So I'll buy too, which pushes prices higher, which attracts more buyers until the bubble pops. Traditional economics can't explain these behaviors. If people were rational, none of this would happen. Behavioral economics has huge implications. For policy, if people don't save enough for retirement because of present bias, maybe we should automatically enroll them in 401s with opt-out instead of opt-in. This nudge dramatically increases participation without forcing anyone to do anything. For marketing, companies exploit behavioral biases constantly. Limited time offer creates urgency. Compare at $199 creates anchors. 9 out of 10 dentists recommend creates herd behavior. For finance, markets might not be perfectly efficient because investors are human and make predictable mistakes. This creates opportunities for smarter investors to profit from others' biases. For everyday life, understanding your own biases helps you make better decisions. You can set up commitment devices, avoid common traps, and think more clearly about trade-offs. The field was pioneered by psychologists Daniel Kahneman and Amos Tversky, and Kahneman won the Nobel Prize in Economics in 2002, which is hilarious because he's not an economist. He's a psychologist pointing out that economists have been wrong about human behavior for decades. Traditional economists are slowly accepting that behavioral economics is important, though many still resist because it makes their nice, clean models messy and complicated. But reality is messy and complicated. Models that ignore this are wrong, even if they're mathematically elegant. Chapter 38. The informal economy, the trillions that don't count. Here's something weird. A huge chunk of economic activity doesn't show up in any official statistics. The informal economy, also called the underground economy, shadow economy, or black market, includes all economic activity that isn't reported to the government. This includes illegal stuff, drug dealing, prostitution, selling stolen goods, gambling in states where it's illegal. This is crime, but it's also economic activity. People produce goods and services, other people pay for them, value is created and exchanged. Legal but unreported stuff. The contractor who gets paid in cash and doesn't report it to the IRS. The nanny who's paid under the table. The guy who sells stuff on Craigslist and doesn't claim the income. The teenager who mows lawns for cash. The waitress who doesn't report all her tips. Household production, cooking, cleaning, childcare, home repairs, all the work that happens within households. If you hire someone to clean your house, that's in GDP. If you clean it yourself, it's not. But the value created is the same. Barter and informal exchange. I fix your car, you do my taxes. Value is exchanged, but no money changes hands and nothing is recorded. Estimates suggest the informal economy in the US is about 10 to 12% of GDP, or roughly $2 to $3 trillion per year. That's a lot of unreported economic activity. In developing countries, it's much larger, sometimes 50% or more of the economy. When formal jobs are scarce or heavily taxed, people turn to informal work to survive. The informal economy matters for several reasons. Tax revenue. If people aren't reporting income, they're not paying taxes. This means less government revenue and higher taxes on everyone else to make up the difference. Labor protections. Informal workers have no legal protections. They can't unionize, can't sue for discrimination, aren't covered by minimum wage or overtime laws. If they get hurt on the job, there's no workers' compensation. Statistics, GDP, unemployment, productivity, all our economic metrics are wrong because they don't capture informal activity. The economy is bigger than we think, and unemployment is lower than official numbers suggest. Inequality. Informal work is often poorly paid and unstable. People working in the informal economy are often poor, and because their work is invisible, policy doesn't account for them. Why does informal economy exist? Taxes and regulations. When compliance costs are high, people evade them. If reporting income means losing benefits or paying 30% in taxes, the incentive to work under the table is strong. Lack of formal opportunities. If you can't get a work visa, can't pass a background check, or can't find formal employment, the informal economy is your only option. Cultural norms. In some communities, cash transactions and unreported income are normal. Everyone does it, so it doesn't feel like cheating. Trust. Sometimes people prefer dealing in cash with people they know rather than through formal institutions they don't trust. Governments try to crack down on the informal economy through audits, penalties, and enforcement. But it's hard to police millions of small cash transactions. An alternative approach is to reduce the incentives for informality, simpler tax, codes, lower rates, easier compliance, benefits that don't disappear when you earn $1 more. Make formality attractive rather than making informality punishable. But this requires political will and often means less tax revenue in the short term, so it rarely happens. Meanwhile, the informal economy chugs along, creating value that doesn't count, employing people who don't officially exist, and reminding us that the economy, as we measure it, is only part of the real economy. Chapter 39. Economic Mobility. Can you actually get ahead? The American dream is that anyone, regardless of where they start, can work hard and get ahead. Your birth circumstances don't determine your destiny. How true is this? Not very, as it turns out. Economic mobility, the ability to move up or down the income ladder, has declined significantly in the US. If you were born in 1940, you had a 90% chance of earning more than your parents did at the same age. The economy was growing, and prosperity was widely shared. If you were born in 1980, you have only a 50% chance of out-earning your parents. It's basically a coin flip. This matters enormously. Inequality is more tolerable if there's mobility. If today's poor can become tomorrow's rich, then inequality reflects temporary differences rather than permanent class divisions. But if the poor stay poor and the rich stay rich across generations, then we don't have equality of opportunity, we have an aristocracy. The data shows the US has lower economic mobility than most developed countries. If you're born poor in the US, you're more likely to stay poor than if you're born poor in Canada, Germany, or Denmark. Where you're born matters hugely. Growing up in San Jose or Seattle gives you much better odds of upward mobility than growing up in Charlotte or Atlanta. The variation within the US is as large as the variation between different countries. What determines mobility? Segregation. Areas with less segregation by race and class have higher mobility. When poor and rich live near each other, there's more interaction, better schools get more broad-based support, and social capital is shared. Inequality. Paradoxically, areas with less inequality have more mobility. When the rungs on the ladder are closer together, it's easier to climb. Family structure. Areas with more two-parent households have higher mobility, even for kids from single-parent households. Family stability in the community matters, not just in your own home. Social capital. Strong communities with civic engagement, trust, and social networks provide support that helps people get ahead. K-12 education quality. Better schools obviously help, but school quality correlates with property taxes, which correlates with wealth, which creates a cycle where rich areas have better schools, which helps rich kids succeed, which makes them rich adults, which funds better schools. College access, college. Dramatically increases earnings potential. But college is increasingly expensive, and poor kids are less likely to attend or graduate. This perpetuates inequality. The decline in mobility has several causes. Rising inequality. The gap between rich and poor has widened, making it harder to climb from bottom to top. Declining growth. The economy grows slower than it used to, so there's less overall expansion to lift people up. Credential inflation. Jobs that used to require high school diplomas now require college degrees. Education requirements keep rising, making it harder for people without degrees to access good jobs. Geographic sorting. Rich people increasingly live with rich people with poor people. This means poor kids go to underfunded schools and lack access to networks that help people get ahead. Declining unions. Unions used to provide a pathway to middle-class income for workers without college degrees. With union decline, that pathway has narrowed. The lack of mobility has political consequences. When people feel stuck, they become angry. They're attracted to populist politicians who promise to overturn the system. They lose faith in institutions, and they're not wrong to be angry. If hard work doesn't lead to advancement, if your zip code determines your destiny, if the game is rigged, why play by the rules? Restoring mobility requires investing in education, especially early childhood, reducing residential segregation, making college affordable, strengthening social safety nets, progressive taxation to reduce inequality, labor policies that give workers bargaining power. These are politically contentious and progress is slow. Meanwhile, mobility continues declining, and the American dream becomes more myth than reality. Chapter 40. The Bottom Line. What Actually Matters. After all these chapters, all these concepts, all these economic theories and policy debates, let's cut through the noise and talk about what actually matters. The economy isn't an end in itself. It's a tool. The question isn't, how big is GDP, or what's the stock market doing? The real question is, does the economy serve human flourishing? And right now, the honest answer is, sort of, but not as well as it could. We've built an economic system that's extraordinary at generating wealth and innovation. We have technology that would look like magic to people from 50 years ago. We can video chat with someone on the other side of the planet. We have cars that drive themselves. We've sequenced the human genome and developed vaccines in record time. But we've also built a system where working full-time doesn't guarantee you can afford housing. Getting sick can bankrupt you. Getting an education can bury you in debt for decades. Your economic fate depends heavily on where and to whom you were born. The planet is warming because we've treated the atmosphere like a free dumping ground. Millions of people are productive and want to work, but the system has no use for them. These aren't natural laws of economics. They're choices. Policy choices, regulatory choices, political choices. The good news is that choices can be changed. Here's what you should remember. 1. The economy is made by humans for humans. When someone says, the economy requires, or the market demands, they're often just disguising their preferences as natural law. The economy doesn't require anything. We decide what we want the economy to do. 2. There are always trade-offs, but the trade-offs aren't always what people claim. We can't afford universal health care is false. We already spend more on health care than countries with universal systems. We can't raise wages without killing jobs is more complicated than either side admits. Question the trade-offs you're presented with. 3. Incentives matter more than intentions. Good intentions don't create good policy. You need to think about how people will actually respond to incentives, including perverse incentives and unintended consequences. 4. Markets are good at some things and terrible at others. They're great at producing consumer goods efficiently. They're terrible at providing healthcare, housing the poor, protecting the environment, and solving collective action problems. Use markets where they work, use government where markets fail. 5. Growth isn't everything. We've been conditioned to think GDP growth is the measure of success, but growth in what? If GDP grows because healthcare costs are rising, that's not success. If GDP grows while life expectancy falls and people are more miserable, what's the point? 6. The future isn't predetermined. Automation doesn't have to create mass unemployment. Climate change doesn't have to destroy the economy. Inequality doesn't have to keep rising. These outcomes depend on choices we make now about technology, policy, and priorities. 7. Economics is political, whether economists admit it or not. Every economic policy helps some people and hurts others. When someone presents a policy as economically optimal, ask, optimal for whom? 8. You have more power than you think. You vote, you spend money, you choose where to work, what to buy, what to support. Individual choices matter less than collective action, but collective action starts with individuals deciding to act. The American economy is an incredible achievement. It's also deeply flawed. Both things are true. The question is, what do we do about it? That's not an economic question. That's a human question. And the answer depends on what kind of society we want to build. Choose wisely. The economy you get is the economy you create. Final thoughts. Now what? You've made it through 26,000 words about how the economy works. Congratulations. You now know more about economics than most people. including most people who post confidently about economics on social media. So what do you do with this knowledge? First, be skeptical. When someone makes a confident claim about the economy, whether it's a politician, a pundit, or your uncle at Thanksgiving, ask yourself, what are they assuming? What are they leaving out? Who benefits if I believe them? Second, think systemically. Everything in the economy connects to everything else. When you pull one lever, 10 other things move. Simple solutions to complex problems are usually wrong. Be wary of anyone who says there's one weird trick to fix the economy. Third, demand better. The economy doesn't have to work this way. Other countries have figured out universal health care, affordable education, strong safety nets, and robust worker protections while maintaining prosperous economies. We could too, if we chose to. Fourth, focus on what matters, not GDP, not the stock market. Ask, are people able to live dignified lives? Can they afford housing, healthcare, education? Do they have opportunities to get ahead? Is the environment sustainable? These are the metrics that matter. Fifth, remember that you're not just a consumer or a worker, you're a citizen. The economy is shaped by collective decisions, and you have a voice in those decisions. Use it. The American economy is the most powerful wealth-generating machine in human history. Whether it generates broadly shared prosperity or concentrates wealth among a few depends on choices we make collectively. Those choices happen in voting booths, in policy debates, in consumer decisions, in workplace organizing, in how we talk about economic issues with each other. The economy isn't some distant force beyond our control. It's us. It's what we make it. So make it good. And maybe, just maybe, the next time the economy does something weird, when housing prices spike, or inflation surges, or the stock market crashes, or some new financial instrument almost destroys the global financial system, you'll understand why it happened. You might not be able to fix it, but at least you'll know who to blame. Thanks for watching.